Mumbai. The Reserve Bank of India has sprung a surprise in the currency market as it tweaked its usual way to stem the rupee's sharp intraday dip against the dollar on Friday. The central bank sold about $200,000 to $250 million in the exchange-traded futures market, for people familiar with the matter told ET. The RBI was relatively less active in the spot and forwards markets, where it usually intervened more to stem currency volatility, despite having a record-high $400 billion in its foreign currency reserves. Analysts see this as the central bank's strategy to protect its dollar walkers amid increasing currency volatility globally. The RBI didn't immediately respond to an email seeking comment. The rupee on Friday slid to 65.16 to the dollar, a level not seen after May 4. The local unit erased its losses later as some state-owned banks were seen selling dollar aggressively on behalf of the central bank, dealers said. It closed at 64.80 a dollar, little changed from Thursday. The rupee is likely to be volatile with a depreciating bias in coming days amid domestic fiscal concerns, said Gopi Krishnan MS, head of foreign exchange, rates and credit for South Asia at Standard Chartered. Also, the dollar may gain strength with unwinding of US Fed balance sheet. We are advising our clients to hedge their exposures. Volatility would continue for the next few weeks as global investors struggle to chart out a future path amid uncertainties, said Notts Day, managing partner at United Financial Consultant, a forex advisory firm. The latest fall will encourage exporters, while prompting complacent importers to cover their short-term liability, he said. 2 days ago, the U.S. Federal Reserve said it would start cutting down the monetary largesse, known as quantitative easing in market parlance, amid renewed rate increase hopes. That means, global investors would exit emerging markets like India to invest in U.S. securities, perceived as the safest in the world. Back home, foreign portfolio investors fretted over the prospect of the government loosening fiscal policy and slipping on its fiscal deficit, in its efforts to boost economic growth. The government's expenditure over revenues is targeted at 3.2% of gross domestic product for this fiscal year. In the past 2 trading sessions, foreign portfolio investors sold about 2,400 crore rupees worth of equities, show provisional data on the BSE. Debt investments, too, showed sign of stress as the benchmark yield remained elevated at 6.66%, 8 basis points higher than the level 2 days ago. Yields and prices move in opposite directions. While these developments could continue to put pressure on the rupee, the RBI would try to curb any wild swings, market experts said. But it would now also be cautious about protecting its reserves. The central bank looks protective about its forex reserves it built when the rupee was trending to rise, said Ananjia Banerjee, currency analyst at Kotak Securities. A futures market intervention would not deplete its dollar stock as the rupee keeps whipsawing amid domestic and global uncertainties. It is always better to have a strong cushion amid expectation of dollar outflows from the country, he said. A week ago, India's foreign exchange reserves surged to a record $400 billion as the RBI bought enough dollars in the past few months when the rupee was rising. Some traders are of the opinion that the RBI may have opted for derivatives over cash as it did not want to influence interbank liquidity through action in the forex market. In the past few months, when the rupee was strengthening, the RBI avoided spot market intervention as large dollar buying would have increased rupee liquidity, seen inflationary